You know, in the world of cryptocurrency, noise is so often mistaken for value. But there's this one project that, well, it doesn't scream, it doesn't chase the hype. And for that very reason, it might be one of the most misunderstood assets in the entire space. Today, we are taking a close look at Hedera Hashgraph, also known as HBAR.
Right. This thing just doesn't move like a meme coin. Its quiet, almost methodical approach can easily look like a lack of excitement. But that deliberate nature, that's actually the key to understanding what it's really trying to do. It was built for a completely different audience with a very different timeline in mind.
And that really tees up the big question for this explainer, doesn't it? Is Hedera's unique, almost corporate-friendly approach a sign that it's about to see massive long-term adoption? Or is it a fundamental flaw, one that's going to leave it stranded somewhere between pure decentralization and traditional finance? Let's dig in and find out.
To really get a grip on Hedera, you have to first understand that it isn't a typical blockchain. Not at all. Its entire foundation is built on a different kind of distributed ledger technology, and honestly, that distinction changes everything.
So, instead of miners lining up transactions into a single chain of blocks, one after the other, Hashgraph uses something called a gossip protocol. Just imagine all the computers on the network, the nodes, constantly and rapidly sharing transaction information with each other. It's this continuous, chaotic-looking flow of information that lets the network agree on what happened, the consensus, incredibly fast.
Now look at this side by side. A traditional blockchain builds its history block by block. It can be slow, and a transaction is only probably final for a while. Hashgraph, with its constant information sharing, achieves mathematical certainty of finality, and it does it in just a few seconds.
And here are the practical results of that design. The Hashgraph engine allows for this massive throughput. We're talking thousands of transactions every second at a very, very low and predictable cost. So here's the crucial point. HBAR isn't trying to be digital gold like Bitcoin. It's designed to be the plumbing, the back-end infrastructure for things like global payment systems, supply chains, and tokenization.
Now, that kind of high performance is exactly what gets big companies interested. But it comes with a structure that creates this deep, deep conflict within the crypto community. Let's take a look at how this thing is actually governed.
Unlike almost every other decentralized network, which is governed by anonymous miners or stakers, Hedera has a formal governing body. And this is probably the single most controversial aspect of the entire project.
And that council, it's made up of some of the biggest corporations and institutions on the planet. Google, IBM, Boeing. These are not your typical crypto startups. Each of these members runs a node. They get an equal vote on the network's direction, and they only serve for a limited time before they have to rotate out.
And this right here, this creates a fundamental paradox. If you're a crypto purist who values leaderless decentralization above all else, this structure looks like an absolute betrayal of the core idea. But if you're a corporation looking to build a multi-million-dollar application on top of it, it looks like stability. It gives you accountability, a clear roadmap, and actual legal entities that you can work with. So this heavy corporate focus has massive implications for the one thing most retail investors really care about, the price of the HBAR token. And to understand its potential, we have to look past any hype and just focus on the cold, hard math.
50 billion. That's the total supply of HBAR tokens. This number is the single most important factor in any price discussion, because no matter how revolutionary the technology is, the laws of supply and demand, they always win.
Let's put that number into perspective. For HBAR to hit a price of just $1, its total market cap would need to be $50 billion. That would place it among the absolute top tier of all crypto assets. Now, it's not impossible, but it frames the incredible scale of adoption that would be required. And to compound that, you have the token release schedule. New tokens are unlocked over time to fund the development and growth of the Hedera ecosystem. Now, while that's necessary for the long-term health of the project, it creates this constant, predictable headwind of selling pressure. It's a big reason why HBAR's price tends to grind upwards slowly, rather than getting those explosive rallies you see in coins with a smaller supply. And that quote really reframes the entire investment case, doesn't it? HBAR wasn't designed to be some speculative, get-rich-quick asset. It was designed from the ground up to be a utility token for a global infrastructure network. And infrastructure, well, it rarely goes parabolic until one day everyone realizes they completely depend on it. So when you consider the technology, the governance, and the tokenomics, where does this leave Hedera? Well, there are really two very divergent paths it could follow over the next decade.
In the first scenario, we have the stall. Here, the promise just never fully materializes. The corporate governance model, while appealing to some, might scare away the broader community of decentralized developers. Faster, more decentralized competitors could end up capturing that enterprise market, leaving Hedera as a functional, but ultimately a niche network.
But then there's the second, more optimistic scenario, the inevitable. In this future, the world sort of evolves to meet Hedera's strengths. As big industries like finance and supply chain management move towards tokenizing real-world assets, the need for a fast, secure, and regulated settlement layer becomes absolutely critical. And in that world, Hedera's corporate governance stops looking like a weakness and starts looking like its greatest advantage.
But even in that wildly successful scenario, there's a crucial, maybe even darker question we have to ask ourselves. If all these massive institutions adopt and use the Hedera network, is value guaranteed to flow down to the retail person holding the HBAR token?
And the uncomfortable answer is no, not automatically. You see, these big enterprises need reliability, low fees, and high speeds. They don't necessarily need or want the HBAR token to go up in value. The success of the network and the success of the token are definitely linked, but they are not the same thing. And that is a critical distinction that so many people overlook.
This really brings us right back to the core tension of Hedera. The entire project is this exercise in measured, deliberate, corporate-friendly progress. But in an industry that is defined by disruptive speed and chaotic innovation, this slow and steady approach could be the very thing that ensures its long-term survival, or it could be the very thing that causes it to be left behind.
So we're left with this final thought. In so many ways, Hedera is what a grown-up version of a public ledger might actually look like. It's stable, it's governed, it's accountable. But the question is, in its attempt to be mature from day one, did it skip that chaotic, permissionless innovation phase that gives crypto its true power? That's the unresolved question, and the answer will ultimately define its future.